Two investors. Both start with $10,000. Both invest for 20 years. Investor A spends hours every week researching stocks, watching financial news, timing the market, buying hot picks, and selling when things look scary. He feels like a sophisticated investor. Investor B puts her money into a boring index fund, sets up automatic monthly contributions, and basically forgets about it. She checks her account maybe twice a year. After 20 years, Investor B has roughly 30 to 40% more wealth than Investor A. She did less work, spent less time, and made fewer decisions, and she won by a wide margin. I'm Max of Monkey Money, and today I am going to show you exactly why that happens and how to build the same system for yourself. Before we get into the mechanics, there is one study you need to know about. It is called the DALBAR study, and it has been tracking investor behavior for over 30 years. Every year it measures two things: how much the stock market actually returned and how much the average investor actually made. Over the past 20 years, the S&P 500 returned about 9.8% annually. That is the market return. The average investor made about 6.8%, same market, same time period. But the average person somehow converted a 9.8% return into a 6.8% return purely through how they behaved. Run that gap over 20 years on $100,000 and the damage is substantial. At 9.8%, you end up with $638,000. At 6.8%, you end up with $370,000. That is a $268,000 difference that has nothing to do with which stocks you picked. It is entirely a product of behavior: buying high, selling low, reacting to headlines, making emotional decisions at the worst possible moments. The market was handing out 9.8% returns for free. Most people just could not get out of their own way long enough to take them. And here's the part that is counterintuitive. The solution is not becoming smarter or learning more about investing. The solution is building a system that removes you from the decision-making process as much as possible. Because in this equation, you are not the problem solver, you are the problem. Your emotions, your reactions, your clever ideas about timing the market, these are what destroy returns. The simple investing system that beats most people works because it makes your behavior largely irrelevant. It takes the human out of the equation, and once you accept that, wealth building becomes almost automatic. Here's what most people do. They get paid, money hits their checking account, they pay bills, spend what they want, and if anything is left at the end of the month, maybe they invest it. This approach has a roughly 95% failure rate. Not because people do not want to invest, but because there is never anything left. Life expands to consume whatever resources are available. You will always find a way to spend money that is sitting in your checking account. The simple system flips this completely. Before you even see your paycheck, a set portion is automatically transferred into your investment account. You set it up once, you tell your employer to direct a percentage to your brokerage, or you set an automatic transfer for the day after payday, and then you forget about it. This is called paying yourself first, and it is the most important financial habit you will ever build. The reason automation is so powerful is that it removes the decision point entirely. You never get to choose whether to invest this month. You never get to negotiate with yourself about whether you can afford it right now. The money's just gone before you can spend it. Within 2 months of setting this up, the adjusted take-home feels completely normal. You adapt your spending to what is available, and you stop noticing the missing amount. What you do not stop is the automatic buying happening every single month, regardless of whether the market is up, down, or sideways. This is dollar cost averaging, and it is one of the most powerful wealth-building mechanisms that exists. You buy when stocks are expensive, you buy when stocks are cheap, you buy when everyone is panicking and when everyone is euphoric. Over time, your average cost per share smooths out, and this approach has been shown to outperform market timing attempts roughly 80% of the time. Think about what that actually means. People spend thousands of hours analyzing charts, reading analyst reports, and trying to determine the optimal moment to get in and get out. And the simple automated approach, which requires zero analysis, zero decisions, and zero ongoing effort, beats them the vast majority of the time just by showing up consistently every month. Here's the honest version of what the simple investing system looks like from the outside. You set it up, walk away, and check it twice a year. It is roughly the investing equivalent of hiding a banana somewhere safe, completely forgetting you left it there, and coming back years later to find it has somehow multiplied into an entire bunch. Boring to watch, but excellent to eat. So, we are automatically investing every month. Now, what are we actually buying? The answer is so simple. It offends people who think investing should be complicated. Low-cost index funds that track the total stock market or the S&P 500. No individual stocks, no sector bets, no cryptocurrency, no hot tips, just boring, diversified, low-cost index funds. Here is the fact that reframes everything. Over any 15-year period, approximately 90% of actively managed funds fail to beat the S&P 500. Professional fund managers, with teams of analysts, access to company executives, sophisticated models, and millions in research budgets, lose to the boring index fund 9 times out of 10. The reason is fees. The average actively managed fund charges about 1% per year. Over 30 years, that 1% fee costs you roughly 25% of your total returns. A quarter of your wealth evaporated to pay fund managers who probably underperformed anyway. Meanwhile, a broad S&P 500 index fund costs as little as 0.03% annually. 0.03%. That difference, compounded over a lifetime, is hundreds of thousands of dollars. When you buy an index fund tracking the S&P 500, you own a piece of the 500 largest companies in America: Apple, Microsoft, Amazon, Google, Berkshire Hathaway, instantly diversified across every major sector of the entire economy. If one company collapses, you barely notice. If one sector struggles, the others absorb the impact. Compare that to picking individual stocks. You need to be right about which company will outperform, right about when to buy, right about when to sell, and consistently right far more often than you are wrong. When you own the index, you do not need to be right about any of that. You just need the American economy to keep growing over time. And in the past 100 years, betting against that has been a losing strategy every single time. Here is where the simple system really separates itself: the time horizon. Most people think about investing in terms of days, weeks, maybe months. They check their accounts constantly and react to every headline. The simple system operates in decades. When you invest with a 20 or 30-year horizon, short-term volatility becomes almost completely irrelevant. The market dropped 10% this month. You are not selling for 25 years. The market crashed 30% in a recession. Your automatic contributions are now buying more shares for the same amount of money. This is the counterintuitive part that most people cannot fully internalize. Market crashes are actually good for long-term investors who are still accumulating. Every dollar you invest during a downturn buys more shares than it would have at the peak. And when the market recovers, which historically it always has, those shares you bought at a discount are worth significantly more. The 2008 financial crisis was devastating if you were near retirement and needed to sell. But if you were 30 years old and kept your automatic contributions running throughout the entire crash without stopping, it was arguably the wealth-building opportunity of a generation. The people who panicked and sold locked in permanent losses. The people who held and kept buying came out dramatically ahead. Here is what time actually does to your money in concrete terms. $500 a month for 30 years at 8% annual return means you put in $180,000 of your own money. Your account will be worth approximately $680,000, $500,000 of which you never actually earned. Compound growth handed it to you for being patient. Push that timeline to 40 years, still $500 a month. Your account grows to $1.55 million. You added 10 more years, which meant an extra $60,000 of your own contributions, but your account value increased by $870,000. Those last 10 years added more wealth than the entire first 30 years combined. If you've made it this far, hit that like button and subscribe to Monkey Money. It genuinely helps us keep making content like this, and we really appreciate every single one of you. Now, the part most people consistently get wrong. You set up automation, you buy index funds, everything is going well, and then you get bored. You hear about a stock that is up 200% this year and start wondering why you are settling for 10% annual returns. So you start tinkering. You move some money into individual stocks. You try to time the market, and every single time you do, you're recreating exactly the emotional behavior that produces the DALBAR gap we talked about at the start. The simple system beats most people specifically because it prevents you from doing that. Studies show that the investors with the best long-term returns are often the ones who did the least. Not because doing nothing is always right, but because the instinct to act, to adjust, to optimize is almost always more expensive than it looks. Every trade has a cost. Every decision has an emotional tax. The simple system eliminates both. Fidelity once analyzed which of their accounts had the best long-term returns. The answer was accounts belonging to people who had died or who had literally forgotten they had an account. Dead people and forgetful people share one crucial trait. They do not panic sell, they do not time the market, and they do not make emotional decisions. They just hold. Your portfolio should be so boring that you have nothing to do. You set it up once. You verify the automation is running once or twice a year. That is it. The less you do, the better you perform. The hardest part of this system has nothing to do with money. It is resisting the deep human urge to feel like you are supposed to be doing something. A monkey who checks on his carefully stored fruit every 5 minutes does not end up with more fruit. He just ends up anxious, exhausted, and with a reputation in the jungle for being that guy who cannot leave well enough alone. There is one critical prerequisite the simple system requires before it can fully work. Your financial foundation needs to be in order first. You cannot effectively automate investments if you are carrying high-interest debt or if you have no emergency fund to fall back on when life goes sideways. 3 things need to be in place. First, high-interest debt. Anything above 7% needs to be eliminated. You cannot out-invest 18% credit card interest. The math is not even remotely close. Second, an emergency fund of at least 3 months of expenses. This is what allows you to hold your investments through a market crash instead of panic selling because your car broke down. And third, you need to be living below your means. If you are spending everything you make, there is nothing to automate. But once those 3 foundations are solid, the system becomes remarkably powerful and remarkably simple to maintain over time. Here is what this looks like in practice. You are 30 years old. You set up automatic investments of $500 a month into a low-cost S&P 500 index fund. You increase that contribution by 3% annually to keep pace with income growth. You do not touch it for 30 years. At 60, you have approximately $1.2 million. You contributed around 280,000 of your own money over those 30 years. The market gave you the other 920,000 just for showing up consistently and not doing anything destructive. Now compare that to someone spending those same 30 years actively trading, chasing hot stocks, trying to time the market. Maybe they have good years, maybe they pick a few winners, but they also pick losers, sell at the wrong time, pay taxes on short-term gains, and miss the market best days because they were sitting in cash waiting for the perfect entry point. Over 30 years, they probably end up with roughly half your wealth despite spending 100 times more effort and attention. Here is what is genuinely hard for people to accept. The simple investing system works precisely because it is designed for humans who are bad at investing. It is not trying to make you a better investor, it is trying to make your weaknesses irrelevant. You are going to panic during crashes. The automation does not care. You are going to get greedy during bull markets. Your money is already in index funds. You're going to have moments where you think you have found a smarter approach. There is nothing for you to act on. The best investment strategy is not the most sophisticated one. It is the one you will actually stick with through good markets and bad, through crashes and euphoria, through 30 years of news that feels important, and mostly is not. And the simple system is sticky precisely because it asks almost nothing of you except patience, which is an ask most people chronically underestimate. You do not need to become a financial expert. You do not need to watch financial news, have opinions about interest rates, or know what any individual company in your fund actually does. You just need to set up automatic investments into low-cost index funds, and then get out of your own way. The question is not whether this works. The data is unambiguous on that point. The question is whether you are willing to be boring enough to actually do it. Because the simple system that quietly beats most people is not a secret. It is just ignored by people who believe they are too clever for simple solutions. Drop a comment and tell me, are you already running a system like this, or are you still trying to time the market? If this video helped you see why simple beats complex in investing, subscribe to Monkey Money for more content that cuts through the noise and shows you what actually works. We'll see you in the next video.